It's happening. It's a bombshell. Trump's 100% tariffs haven't even started yet, and the customer suspended orders are already here. All 3 orders have been suspended. The materials are ready. The goods are all done. What am I supposed to do with all this stock in the warehouse? Fellow foreign trade workers, have you received this kind of notice too?
特朗普又疯了。
They're adding a 100% tariff to all goods from China, which means if a pair of scissors costs 10 yuan, we'll have to pay over 15 yuan in tariffs to get it to the US. Because of these tariffs, US customers are either lowering prices or canceling orders. For factories making products from the US market, orders are dropping and stock is piling up. Slowly, the risk is that profits might drop to zero. This is a crisis, and I'm not sure if our small factory will get a chance to turn things around. The US trade war with China just escalated. American businesses are canceling foreign trade orders, and Chinese companies are being forced to stop production. Business owners are struggling, but what does production halt mean for foreign trade workers? Are they really going to add 100% tariffs on us too? This is still in the threatening stage. A lot of small business owners see news like this and they're totally defeated. What are we supposed to do with this business? For factory owners, you know the deal. If your customers are all in the US and suddenly they stop ordering, then you're stuck with rent for the factory and people's wages. You can't just wait. Some bloggers lead you to believe that this tariff war won't have much of an impact. Those people make money from getting views on videos. The truth is, this trade war is disastrous for Chinese foreign trade businesses.
I think the worst hit this year is the foreign trade industry. On April 7th, the tariff war hit suddenly. It was a surprise, catching domestic export companies off guard. We were one of those companies, and we're in the export business too. Then, after struggling for months, customers started placing orders again in July and August. But then, on Friday, we got another round of suspensions from American customers. The orders placed before the National Day holiday are now all on hold. Now, it's back to a wait-and-see situation. When 2 countries are at war, it's the ordinary people who suffer. We in foreign trade are like walking on a time bomb.
After a brief calm, the US-China trade war is back in full swing. On October 10th, President Trump said that from November 1st, tariffs on China will go up to 100%. This is a new round of escalation where tariffs are being used like a big stick. Right now, the average tariff on Chinese goods in the US is 57%, but if this really happens, the overall tariff rate will hit 157%. The spark for this new round of tariff war was China's announcement on October 9th of new export controls on rare earth metals and related products. Rare earths are key materials for making electric cars, batteries, and military equipment. Beijing said this move was a response to the US's continued expansion of tech restrictions. However, Trump said he was caught off guard and accused China of ruining the good relationship between the 2 countries in recent months.
One of the things I want is
on October 19th, during an interview aboard Air Force One, Trump listed rare earths, fentanyl, and soybeans as the top issues in US-China trade relations. As the CCP's 4th plenary session was taking place, the National Bureau of Statistics of China released data on October 20th showing a 4.8% year-on-year GDP growth in the 3rd quarter of 2025, a 0.4 percentage point decline compared to the 2nd quarter. While this seems like a small fluctuation, it signifies a collapse in overall economic confidence. According to the explanation from the National Bureau of Statistics, the international and domestic environment became more complex and volatile in the 3rd quarter. Specifically, the US's unilateral actions in trade since the 3rd quarter have had an impact on China's economy. This rare public acknowledgement by the Chinese government of the economic downturn caused by the US-China trade war highlights the gravity of the situation. Another internal factor contributing to the economic decline in the 3rd quarter is a drop in fixed asset investment, which decreased by 6.3%. This is an unusual occurrence for China's economy under normal circumstances. A decline in fixed asset investment indicates a halt in capacity expansion, a contraction in demand, a reluctance to spend by consumers, and a reluctance by businesses to expand. This situation has led to the spread of deflation. Real estate investment dropped by 13.9%, severely pulling down the overall investment growth. According to data released by the National Bureau of Statistics in September, the price of new commercial residential buildings in 70 large and medium-sized cities fell by 0.41% compared to the previous month, marking the largest decline in the past 11 months. In August, the decline was 0.3%. Meanwhile, the price of second-hand homes dropped by 0.6%, the largest decline in the past year. The continued slump in China's real estate market for the past 4 years has dragged down the economy. Real estate used to be the lifeblood of China's economy. Housing was not only an investment, but also a pillar for local government finances, bank collateral, and family assets. Now, this lifeline is being severed. Regarding consumption, in September, the total retail sales of consumer goods increased by only 3% year-on-year, 0.4 percentage points lower than in August. The sales of home appliances, in particular, plunged from 25% to just 3%, showing that the stimulus effect of consumption subsidies is waning. In the entire third quarter, per capita consumption expenditure was only 7,266 yuan, a 3.4% year-on-year increase, significantly lower than the 3.7% year-on-year growth of nominal GDP in the third quarter. Among them, urban residents' consumption expenditure grew by only 2.3%. Some Chinese economists believe that the main reasons for China's economic slowdown are the 6.3% drop in fixed asset investment, the expanding income gap, and weak consumption, with per capita consumption expenditure only growing by 3.4%. The long-term reliance on investment and export-driven models has made the economy vulnerable, with deflation continuing for 10 quarters and structural risks becoming prominent. There is an urgent need to increase support for Social Security and household income to shift towards a consumption-driven economy. Otherwise, growth will be hard to sustain. On October 13th, data from China's customs showed that exports to the U.S. fell by 27% year-on-year in September, and by 16.9% from January to September, confirming the ongoing downward trend in the economy. Official data also revealed that in September, China's Producer Price Index fell by 2.3% year-on-year, marking the 36th consecutive month of decline. Given that the Chinese authorities are known for concealing difficulties, the real situation is believed to be even worse. For a long time, China's economic growth relied on premature fixed asset investments and rapidly growing exports. It can be said that the Chinese government sacrificed personal income and consumption to collect more national income, for instance, by draining the wallets of ordinary citizens through real estate to fund infrastructure and manufacturing investments. When manufacturing capacity became excessive, export tax rebates were used to boost exports and digest the surplus. Now, under the continued background of the tariff war, China's reliance on exports has weakened. China's GDP is unlikely to meet the official 5% growth target. Several foreign economic institutions predict that China's economy will slow further in the fourth quarter of this year and into 2026. A Reuters survey of economists suggested that China's economic growth will drop to around 4.3% in the fourth quarter and beyond. The International Monetary Fund also expects China's economic growth to slow to 4.2% next year, which is in line with the Reuters forecast. Some Chinese entrepreneurs are feeling rather pessimistic about the future of the US-China trade war. On October 18th, Lan Shili, the former richest man in Hubei, posted a video on Douyin. As we all know, in recent years, China has been severely affected by the US-China trade war, and many foreign trade companies have either relocated or collapsed. Then came the tariff war, which made everyone fearful. After a few years, now there may be a new round of trade wars with tariffs of up to 100%. This is terrifying. If this actually happens, foreign trade companies in China will face a heavy blow. Moreover, companies that are beneficial to China's external development will also face many obstacles. A business owner in Foshan, Guangdong, who deals in home products, expressed, "The new round of US tariffs has started again, and it seems it will escalate further. Many people may not understand the situation we, the frontline export factories, are facing. For foreign trade factories like ours that focus on B2B customers, the impact is actually very significant. The export data for the first half of this year is already out, and the overall export value of the home industry has declined. Based on feedback from our customers, market demand is noticeably weaker than previous years. From what I know, the aviation situation here in Foshan is also not optimistic. Those who shout about decoupling online don't understand the struggles on the ground. I'm not pessimistic about the market. I'm just sharing the real feelings of us who are on the front line. After all, in the current environment, how many are not affected? Which industry isn't in a tough situation right now?
美国市场占比大概多少？
What's the proportion of the US market for you? Around 60%? How much does the US market account for? Around 40%. Is this for the US? Yes, computer mice exported to the US. Has the recent US tariff affected them? It has had a huge impact. What does it mean when one country imposes over 100% tariffs on another country? It means they can no longer do business. It means complete decoupling.
出口的东西成尾货。
Exported goods are now just leftover stock, sold by the ton. Each item is only worth a few cents. Nobody is coming to collect them. This is Jiaxing, a 20,000 square meter foreign trade warehouse. Items like these knives are sold by the ton, averaging just a few cents per piece. These exported whole shoes, a few cents each. Right now, we're sorting various clothes, which are piled up and haven't even been sorted yet. How do we sell them? By the ton. Each item costs only a few cents. Now, even figurines exported to the US can't be sold anymore. There are over 40,000 left. In the US, these should sell for dozens of dollars, but here they're only a few cents. These socks, blankets, pajamas haven't been sorted either. There are tons of them, and no one's coming to pick them up. 4 people are sorting them, and who knows when this will end. Shifting from export to domestic sales is really hard. We have to find new customers. We've been doing foreign trade for so long, but we don't understand the domestic market. Nobody is consuming domestically. In Dongguan, once known as the world's factory, the end of the year was supposed to be the peak season. After National Day, more and more factories are shutting down, and the level of desolation is shocking. In the warehouses of scrap dealers, secondhand machine tools are piling up, and the owners are calling it the end of Chinese manufacturing.
这是彻彻底底的完了。
This is it. It's really over. These machines are going to be scrap metal. They're piled up everywhere. Since August, factories in Dongguan and Shenzhen have been closing one after another. These machines have been sitting here for 10 to 15 days, and no one has come to look at them, let alone buy them. Each machine here is devaluing. If this keeps going, they'll really turn into scrap metal. Some of these machines haven't been phased out. Many are from factories that closed. Some were used for just a few months, or even only 5 or 8 hours. What are we going to do if this continues? What's going to happen to manufacturing? With the escalation of the US-China trade war, Chinese foreign trade companies are facing sharp reductions in orders. Re-export trade has become a gray channel to combat the tariff war. By rerouting exports to third countries, Chinese companies are trying to bypass US sanctions to maintain foreign trade and data growth. The new 100% tariffs imposed by the US have left Chinese foreign trade bosses in Southeast Asia panicking.
一个在东南亚市场卷到底的宝。
A mum in the Southeast Asian market who is deeply involved in the industry said, "The tariffs have been raised again. A lot of US sellers are saying they'll turn to Southeast Asia. I was shocked. Please don't make Southeast Asia your safe haven. I'm telling you honestly, the entry barriers here aren't high, but where the barriers are low, competition is fierce. Profits are squeezed out. If you earn 5 yuan on an order, someone will come in and take the business for just 3 yuan. Now, a bunch of people are flooding in."
China's economy has long relied on exports to drive growth, especially after internal demand engines like real estate and infrastructure have stalled. Foreign trade has become a crucial pillar for maintaining employment, securing foreign exchange, and keeping the industrial chain running. However, if President Trump's proposed 100% tariffs are implemented, it will deal a substantial blow to China's exports. Faced with external blockades, China has proposed a strategy of domestic circulation as a mainstay. Despite a series of measures by the Chinese government to stimulate the economy, each measure seems reasonable, offering subsidies to encourage consumption and supporting young families to boost their purchasing power. But against the backdrop of unstable income expectations and insufficient social security, the public is more inclined to tighten their belts rather than increase spending. This means that even if the CCP attempts to rescue itself through internal circulation, it will be hard to make up for the economic gap caused by the breakdown in foreign trade in the short term. The structural problem of weak consumption cannot be solved through administrative mobilization or political slogans. The US trade war has evolved beyond simple economic friction into a deeper confrontation over systems and strategies. China is countering the US with measures like rare earth export controls, while the US is using tariffs as leverage to try to force China to make concessions. On October 21st, Trump stated he expects to reach a good trade agreement with Beijing at the upcoming Asia-Pacific Summit next week, but he warned that a meeting with Chinese President Xi Jinping might not take place. If high-level US-China talks at the end of October fail, pessimism will escalate. Davy J. Wong, an economist based in the US, pointed out that the US imposing extreme 100% tariffs on China is not just a short-term trade loss, but could potentially trigger a cliff-like crisis in China's economy and society. First, small and medium-sized enterprises will be crushed. A 100% tariff means that business will be impossible, leading to a direct and fatal cliff-like blow to China's export business. A large number of SMEs that rely heavily on the US market have low profit margins and high leverage will exit the market or even go bankrupt. Even if some products can still be exported, they will have to be drastically reduced in price to offset the tariff costs, further eroding profits. Second, the private economy will be suppressed, leading to social unrest. After the trade war escalated in 2025, early signs have already appeared, with a 20% increase in the bankruptcy rate of SMEs and state-owned enterprises, now accounting for 45% of exports. This means that only businesses with significant capital, large-scale, or government subsidies will survive, leading to increased industry concentration. The private economy, which used to account for 80% of employment, now faces the risk of being castrated. As a result, export-dependent regions will face massive unemployment, a sharp decline in economic vitality, young people struggling to find jobs, negatively impacting social stability. Furthermore, the government will be forced to re-enter the market with increased fiscal spending to stabilize the situation, which will worsen both local and national debt crises. Third, the limitations of hedging strategies. Businesses turning to Europe and emerging markets is a necessary hedging strategy for survival, but it cannot fundamentally solve the structural production crisis. This is because the purchasing power and credit risks in new markets are not on par with the US, and doing business in emerging markets involves complex political and economic factors. Wong also mentioned potential countermeasures by the CCP to pressure the Trump administration. However, he believes that although China has countermeasures, US-China relations have not yet reached the point of full-scale war, though certain industries are already facing life-or-death challenges. Some netizens have pointed out that since 2025, China's economy has been barely sustained by the government's aggressive tax hikes, the central bank printing money, and re-export trade. However, these three measures only have short-term effects and are unsustainable, instead accelerating the fragility of the economy. There's a high probability that 2026 will be the year of a major economic collapse for China.